let's go through the 2010 investment climate. Let's talk about what we expected. Let's grade ourselves on how right we were. Then let's demonstrate what kind of performance we were able to harvest. Let's move into 2011 and take a look at what we see as the backdrop in the economic environment, where we're positioning assets, what we expect from the markets, et cetera. Y'all ready? All right, let's do it. So if you recall, those of you who were here last year, we expected 2010 to be a year of rehab. And what I meant by that was rehab is emotional highs and emotional lows, but ultimately you're making progress. And that's what ended up happening last year. So here were the things that we expected to happen and how well we did. We expected that equities would grind higher along with earnings growth, and they did. We expected that small companies would outperform large companies. Now, if you've missed the newspapers in the past couple days, well, not the past couple days, but the 2 days before that, the market finally got back to being up 100% from the low in March 9th of 2009. Now, small caps have actually gone up 135% or so. Last year, large caps were up about 15%, which is the bogey. Small caps were up about 30%. So not only did small caps outperform, they outperformed a lot. In terms of style, we kind of expected that the value style would outperform the growth style. It actually did in our portfolios, but in the market overall, it did not. So I have to take a hickey there. In terms of domicile, this was a bet I never should have made, like betting green on roulette. I expected that the domestic and the international markets would tie, and in fact, they did. What are the odds? And then in terms of interest rates, we expected short-term rates to rise because we felt like the U.S. economy might be able to gain some speed coming into the recovery. Indeed, the Fed stayed on hold, launched QE2, as you know, and so short-term rates went nowhere. In terms of the U.S. dollar, we thought the U.S. economy might have a relative advantage in terms of the pace of recovery on the planet, and that would strengthen the dollar. Indeed, it did. In terms of bonds, we wanted to avoid things that were issued with government guarantees, and we wanted to rotate towards things that were issued with corporate guarantees, and that ended up being the right way to go. Okay, now, 2010 was fraught with anxiety, and so as I was trying to figure out a way visually to demonstrate that, I thought I'd take you through the year in gold. So we had BP, we had Obamacare, we had Portugal, we had Greece, the riots on TV, we had FinReg, ultimately we had the midterms, and by the end of the year, gold had ascended from $1,100 an ounce to $1,400 an ounce, where it sits today. So it was a year fraught with anxiety. But something else was happening in the background. For instance, S&P 500 revenue was recovering. Profits were surging. Profits ended the year back near where they were at the top of the previous cycle. And in fact, as a percentage of GDP, corporate profits ended up being right back where they were near the top. That could not ultimately be denied. But with all the anxiety that we had in the early part of the year, stocks really just could not get out of the starting blocks. However, by the time we got into September, the PE ratio on the S&P 500 had actually been compressed down to 12. 12. Now, to put that in perspective, we bottomed in the early 80s cycle when nobody wanted anything to do with stocks and interest rates were 25% or whatever they were at 8. So at this point, the market's really darn cheap. The Fed steps in, and that's the catalyst necessary to unlock that value, and markets surged higher from there by 30%, and they're still kind of headed that direction. Now, because of all the liquidity pumped by the Fed, because of all the supportive actions by Congress, it was pretty much everybody in the pool last year. Stocks were up 15%. Here's gold up 30. Here's the emerging markets up 19. But that liquidity infusion pushed everything higher. So gold, stocks, oil, treasury bonds, hedge funds, the dollar, all going the same direction, kind of craps out your textbook economic model. But in reality, that is what occurred. Now, I had to work to find an asset class that did poorly last year, and so there you go. Natural gas was down 20% because we just find more and more of that stuff. All right, in terms of country performance, the globe was really very healthy last year, and so the only place you got hurt was in the pig countries, if you will, Greece and Spain and Italy and Ireland and Portugal. China actually struggled a bit last year domestically, down about 7%. Now, a couple of the emerging markets did hold their own against us. You know, here's Hong Kong, here's Russia, but we defeated China, we defeated Brazil. So the United States kind of held its own last year. And so you can see, if you do the average of this, you end up basically where we were. In terms of sector performance, if there's one thing you should take away from the State of the Union, those of you who've been here for years, is never bet against the U.S. consumer. So consumer discretionary names were up 28% last year relative to the benchmark, which was 15. Industrials did well. The global economic cycle really started to spool up, and that was good for the industrial names, also good for the materials names, good for the energy names, all good early cycle names. The places where you didn't want to be last year, the secure places. Healthcare didn't do well. Consumer staples didn't do well. Financials can't quite figure out whether it's good news or bad news every day they wake up. Technology surged into the end of the year but lagged last year. So again, never bet against the U.S. consumer, and we didn't. So let's take an account of how we did last year. Those of you who are clients know that the way we invest the equities is within a framework of 45% allocated to the growth style of investing, 45% allocated to the value style of investing, and then 10% allocated to what we call special situations, which are areas or opportunities that we see in the market where maybe we hold them for a shorter term period, maybe we can generate some excess return. Last year there was return everywhere. In terms of growth, the growth side of the portfolio was up 17.7% last year. The value side was up 22% last year. So, like I said, we outperformed actually on our value managers. And then in terms of special situations, it was all special situations last year, and that was up about 20%. So the bogey, what we're trying to beat, the S&P 500 was up 15.1% last year, an above average year. And we were up 20% gross and 18.7% net at our highest fee. So, thank you. I wait all year for that and hope that that's how that turns out. All right. So it was an above average year, and fortunately for us, we were above the above average. One thing I will note, I did a screen this morning just to verify this. There are like 10,000 mutual funds, and every year Morningstar awards Manager of the Year to 3 managers. And one of the managers in our portfolio that we've held for a couple of years now did receive the International Manager of the Year. So it's great when you can get the macro calls right. It's even better when you can get the manager calls right. You pay us to do that, and at least last year we did. So congratulations to Brett Lynn, but most of all, congratulations to all of us.